Hi there. I am going to quickly record this video following our Zoom call yesterday night when the market opened Sunday night. And we briefly looked at this from one of our members in the 530 Profit Club. She had the strategy that she traded and she believes is a very profitable system. And so I agreed to record a video based on those rules, and so the entire team will be testing this out to see how consistent this is. But I do see potential in this. It just needs to be developed further. Okay, so it's going to be a candle pattern that is combined with Bollinger Bands, as it were. So the candle patterns we'll be looking at will be two candle patterns, and that will be the outside bar and the engulfing bar. Those two patterns will be what triggers either a sell or a buy opportunity on the chart for us and based on the system. Okay, and so for the outside bar, it is a situation where you have trend bias and then there's reversal. By the way, what I will say at this point is these two candle patterns are reversal patterns, so there must be a prior trend bias before we then look out for potential for reversals, which would be the reason for that candle pattern. So they are typically two candle patterns, so it has to be two candles. And in the first case here, we're going to look at a bearish option, and what that means is that there must have been a prior bullish price action. 2 or 3 candles or more is acceptable or acceptable. As you can see in this case, we have just drawn up 3 candles. But if we have 2 bullish candles prior to the candle formation, then that's fine. And with the outside bar, what we're looking for will be, you will notice that the reversal candle must be a red candle, so a bearish candle, which then signifies that price could potentially be going down. But what we want to find out is within these 2 candles here, that the bearish candle high, so this candle 1 high must be higher than candle 2 high, right? And candle 1 low must be higher than candle 2 low. And once that happens, we then want to look out for an expected down move, which means we want to sell. Typically, what you will want to do will be to actually sell at that level there. That's aggressive, or you can wait till price breaks this low here to then enter. So either of those are entry potentials. And then what needs to happen is the stop loss needs to be at this level here, a few pips per spread above this level here. So your entry will be down there. So stop loss, entry, and what you want to do then is to have a target that is at least 1 to 1. With this system, it's likely you can get even 2, 3 to 1. So what you technically want to have is a target that is about that level there. So you want a target that is about that level there, at least 1 to 1. So anything from this level here is good enough, and you should be able to even get 2 to 1 in certain cases, as it were. So yeah, about 2 to 1, 1 to 5, 2 to 1. But yeah, from 1 to 1, you're good to go, as it were. And the reverse is the case for the bullish option. So there must be a prior bearish trend or bearish bias, and then we have the formation of a green candle, which is a bullish candle in this case. And what you want to see is that the high of the signal candle, the candle 1, must be higher than the high of the last bearish candle, and the low must be lower than the low. That's simple enough. And again, once again, in this case, you want to have your entry around, you could have the entry around here as this candle just closes, and that will be an aggressive move. My preference would be to take it up around here, and then the stop loss will be a few pips. So at the low minus the spread should give us the stop loss, and then we want to aim for 1 to anything above 1.5 will be okay for the target. So anything around here is technically good enough, and typically this happens, price moves back and touches that level. Okay, but in this system we're going to be looking at, we will be using the Bollinger Bands as some help to know when price is this technical term they use, overbought and oversold conditions. But we'll see. We'll see how this turns out. Okay. Right. So the next candle we'll be looking at is the engulfing candle. Kind of similar to the outside bar, but in this case you don't need to have the high of the bearish candle higher than this one. The key thing here is that the close of this bearish candle must be lower than the low. So the close, which means that there is a clear break of this level here, because you know that the low of any candle is actually a structure level. So what's happening here is when you get a close below that level, then you have a break of that level, and then there is potential for price to continue to move down. So as long as there's a break of that level, follow the move downwards. And it is the opposite for the bullish. So the close of this bullish bar, must be higher than the high of this candle number 2, as it were. So maybe we want to go to the chart and see some examples of these before we then come to Bollinger Bands. Right. So this is without any other rules to the candle formation. So let's just find situations where we either have an outside bar or an engulfing candle. So let's look for outside bars first. So let's say this is an outside bar. Can you see that? But remember, we want to see that price has had recently a trend bias or a directional bias, and in this case we've had a directional bias to the downside, and so we get this here. So we can see this is a perfect situation, and this is an outside bar because you can see that the high of that candle, the high of that candle is higher than the high of this candle, and let's get another one, and the low of that candle, let's pull it up, and the low of that candle is also lower than the low of the green candle. The bullish candle is lower than the low of that, and so that's a perfect what do you call it, a perfect outside bar. And we can see that if our entry was at that level, it got filled in at that level there, and that's the stop loss there. And if you had gone for 1 to 2, 1 to 1.5, you can see clearly that that we do have. So if we went for to just look at this, you can see that that's actually more than, so that'll be 1 and that'll be around 2. So even if we went for 2 to 1, you can see that price actually got to there. So if our entry was there, stop loss there, boom. Okay, so that was nicely done, that one. Let's do for another inside bar. I'm sure maybe you'll find one that I'll miss out. Oh, that's one there. Can you see? So bullish, and then we get this high here and this low here, lower than this and higher than this. And then if you went for, so we're looking for a reversal to the downside. So the entry, the conservative entry will be from here, but the aggressive entry will be here, and that would have then taken us down to the downside. And let's see if price actually hit stop loss. Now that will be stop loss plus spread, so that means we could have just been saved on this trade and would have been taken out, or maybe been taken out, either way. But if we didn't get taken out, then this would have been a nice trade, because the entry would have either been here, which is conservative, so that would have been nicely done there, and the stop loss would have been here. And then if you look at it, we will have us a 1, something like 2 there. So again, clearly you can see that we would have had a nice exit at least 1.1 to 1 to 1.5. Okay, that's good. So now let's look for some engulfing. Clearly this is one engulfing here, so that's an engulfing candle. See, this price here closed below, and this was bullish, and price closed below the low of this here, and stop loss would have been up here to oh, this is 5 minutes chart, so this would have been a 2 pip or maybe 5 pip stop 5 pip stop loss, and then price just fell apart here. It's not bad. Even this, okay, no, that's not it's a bearish again. This one was bullish, and then boom, fall apart. Things fall apart. Now there is one as well here, so you can see this here. So price closed, so this was bearish down here, then this one closed above, and so entry would have been here, stop loss would have been 3 pips or plus spread maybe 4 pips, and you can see price never came back to our stop loss until we got even up to this level here, 12. So that's 3 times 4 times the stop loss. Okay, I hope that's clear, but let's quickly then look at the Bollinger Bands rules. So Bollinger Bands are just bands, so it's got the upper line, the lower, it's called upper band, lower band, and then there's a middle band. The middle band is usually a moving average, and the default is 20 or 21 moving average, and the upper and the lower bands are just simply standard deviations, so which by default on the platform is 2 standard deviations. So this will be at any point 2 standard deviations from the center will give us to the top, will give us the upper band, and 2 standard deviations from the middle band to the bottom will give us the lower band. All these are automatically calculated by the indicator, which comes by default with the MetaTrader 4 platform. And so once you place it on the chart, that's what you see. And so now let's look at how this is used to actually trade. Shamu's technique. So if I go to GBP USD M5, so the rule, what the Bollinger Bands help us do is, you can see that once price is going up like this, the band actually expands and increases rapidly. And so if we're going to look for some bearish price action, bearish movement, you can see once you have price break above the band, and in this case is a bullish, you can see 1 2 3, price breaks above the band. If you then get a bearish candle close below the band, and in this case it gives us an engulfing pattern, and then what we want to do is to then take a sell trade there, and that's 16 pips, and we would then follow it to the end there. So it's almost 1 to 2. That's not bad. We can see down here this was an outside bar, so price coming here touches this, then the next candle closes above, the low is also lower there, and it is 8 pips here and 26 pips, which is 3 times. Which other one do we see? So that's not an opportunity there. We didn't get an opportunity there. None there. Did we get any here? No, we didn't get any here. We didn't get any here. We didn't get any here. This is not very clear, so that's fine. It's not clear direction. Here, not quite. So every touch of the band is not an opportunity, by the way. So we have another one. Oh, we have one here. Can you see this here? So this candle here is actually, it's either an outside bar or an engulfing bar. So that high there is higher, just higher, all the same. And we can see then we took an entry there, stop loss 10 pips or 11 pips. We can see 31, hit up to 31, so nicely done, nicely done. We can also see if price can also bounce back from the middle band, and that's also a legit entry. So in this case where we had this here, so you can see this was a bearish move down, touched the band, then this one closed above, then that would have been an entry there with stop loss at 12, 13, 15 pips. I would have just taken this up, and that's close to 1 to 2. So nicely done as well. That's another outside bar there. Can you see it? So bullish outside bar, take the entry there. Stop loss is about 8 pips, and before the market closed on Friday, if we are taking profit, we wouldn't have taken profit because our stop loss wouldn't have been, our target wouldn't have been hit. But you can see what price did by the next day. 29.30, so almost 1 to 4. That's awesome. Okay, I hope that that's clear. It's a short video. Any questions, please get in touch or just drop them in the comments. All right, until next time, you take care, and let's talk soon. Cheers.